This analysis is on how economies transition from inflation to stagflation, and how economies break free of the inflationary cycle. Through the 2020 pandemic, economies around the globe engaged in aggressive monetary policy to support their economies because of the health risk of the pandemic. Central banks use three monetary tools to stimulate economic activity or depress it: lowering interest rates, purchasing financial assets, and putting money directly into consumers is stimulative, while increasing interest rates and selling financial assets is depressant. Central banks' objectives are to stimulate or depress economic activity for supply and demand to be in balance. If demand outpaces supply, then you get inflation. If supply outpaces demand, then the economy can find itself in a stagnant environment with slow economic growth. Economies are not entities with an infinite amount of money and resources. They are constrained by their population size, who can contribute to the economy and the available resources. This sets a limit on how much products and services an economy can produce. Therefore, the amount of purchasing power of an economy needs to reflect how much an economy can produce. If there were no such constraints, countries everywhere could simply print money and buy everything they need. What you see globally is that many countries borrow money either domestically or globally to finance purchases. During the 2020 pandemic, economies like the United States used their three levers of economic policy to stimulate the economy. In January 2020, the federal funds rate stood at 1.55%. In March 2020, COVID-19 was declared a pandemic, and by April of 2020, the federal funds rate had been decreased to 0.05%. The federal funds rate would be increased to 0.08% in February 2022. At the time that the federal funds rate was being decreased, the Federal Reserve was also engaging in M2 monetary policy by purchasing corporate bonds. The purchase of corporate bonds injects liquidity into the economy at the same time that it lowers risk premiums. While the central bank has a direct influence on the federal funds rate, the prime rate is influenced by the market. If lenders determine that the economic environment is too risky, they will demand a higher spread from the federal funds rate that it is set by the central bank. Since the economy had come to a standstill because of social distancing policies to reduce the spread of the virus, monetary M3 policy was authorized, where money was given directly to consumers and businesses with mandates on how it could be spent. Businesses receive PPP loans that could be 100% forgiven, while citizens receive payments based on specific criteria set by the government. In March 2021, the inflation rate stood at 2%, which is the central bank target rate in the United States. Since then, inflation continued to increase, and by 2022 it had evolved into stagflation. Stagflation is defined as an economic period of continuously high inflation accompanied by stagnant economic growth. As previously explained, economies have a limit to how much products and services they can produce because of the number of citizens active in the labor market and their expertise. When an economy begins to overheat, it is because it is reaching its maximum capacity to produce. Therefore, central banks will begin to increase interest rates for supply and demand to align at equilibrium. In the case of the United States, too much purchasing power was infused into the economy that demand outpaced the economy production ability to satisfy demand. Because demand outpaced supply, we can see from the graph that inflation rose above the economy productivity rate sometime after Q1 of 2021. This reinforces the observation that prices rise when there are too many dollars following fewer goods and services. The inverse relationship between inflation and productivity can be seen when we graph a regression line. It shows that when productivity increases, inflation decreases, and vice versa. As previously stated, the economy in the United States transitioned to stagflation in 2022. Central banks navigate stagflation environments by increasing, pausing, and lowering interest rates. In the United States, The central bank has a dual mandate that was approved in 1977 to maintain stable prices and full employment. Therefore, increases, pauses, or decreases in interest rates would be based in accordance with this dual mandate. The central bank began to pause interest rates increases in June of 2023. The pause of interest rates increases gives the general public the expectation that the economy is back to good health. As a result, asset prices increase rapidly, which then leads to an increase in inflation again. This pattern of behavior will continue until the economy is at the target rate set by the central bank. What determines if inflation has been brought under control is when the productivity rate of the economy rises above the federal funds rate or prime rate. Cases in the past show that if important institutions are at risk, like in the 2007 recession, the economy navigates free from the recessionary environment after the economy productivity rate is above the prime rate. Instances where important institutions are not at risk, the economy has broken free from the recessionary environment after the economy productivity rate rises above the federal funds rate. Regarding when the United States' current stagflation environment would be over, the more likely scenario is when the economy productivity rate is above the prime rate. In the 1970s, the economy was engulfed in a stagflation environment. In 1978, it appears the inflationary environment was coming to an end, but then the oil crisis happened, and the economy experienced higher inflation. It was not until 1983 that the economy rose above the prime rate. After that, the economy was able to break free of the inflationary environment. The economy productivity rate is still below the federal funds rate and prime rate. Once the numbers begin to converge, we can expect inflation to subside.